Commodities seem to be on the rebound, but will this resurgence also see the currency recovery continue? Well, data from the exchange-traded funds sector show a surge in net capital inflows into 41 exchange-traded funds, or ETFs, buying stocks in South Africa to a 5-year high of $136 million in the first quarter. Sounds like a lot of money, but is it? This is the MoneyMakers. I'm Bruce Whitfield. I'm joined by Nerina Visser. She's an ETF strategist. She's also an advisor at ETFSA to discuss the bullish sentiment we're seeing and the switch we're seeing into ETFs. Is it a sign of investors, one, going into exchange-traded funds and also money returning to South Africa after 16 consecutive quarters of outflows? Where do we start with this? Lots of angles to pluck on this. Firstly, let's just look at the ETF universe. We're seeing huge growth in ETF uptake. It's really quite interesting.
Indeed, as at the end of March, assets under management within ETFs globally exceeded $3 trillion. It's happened before, but then we obviously had some weakness in markets, and with this latest resurgence, once again above the $3 trillion mark.
In South Africa, what sort of growth rates are we seeing in the ETF market? Because it's been a very, very slow uptake.
It has. And South Africa certainly has been a big laggard in terms of the uptake, in terms of ETFs in particular, maybe less so in index tracking products. So we can differentiate between those two as well. And there's all sorts of reasons
tracking
for
product,
it.
More like a unit trust that you
or
would
even
buy.
A segregated portfolio, mandated portfolio. So there's all sorts of reasons for that, and without going into that sort of, I think what we do need to also acknowledge is that the exchange-traded fund industry in South Africa is 16 years old. So this is not a new kid on the block. No. It's been around for a long time. Yet when you look at the unit trust industry in South Africa, it was first created in 1965. It was only really in 1990, so 35 years later, that the unit trust industry actually became mainstream. And where we are in the same sort of growth cycle, or the along maybe this S curve or the J curve that you've got for ETFs, quite quicker and much further ahead than the unit trust industry were at the same sort of stage of its development. So are we at the tipping point in South Africa yet? No, probably not quite just yet, but I think we are certainly moving a lot faster towards increased use of index tracking, or so-called passively managed vehicles, than we've had ever in the past.
What percentage of South African assets under management are index tracked versus being actively managed?
Minuscule, you know. Not even. Although to get numbers on pure index trackers in the segregated portfolio space is extremely difficult. I think there are a lot of closet index trackers. I mean, if you just take the PIC, for example, that owns more than 10% of South African assets under management, and the majority of their equity portfolio is really benchmarked and managed on a SWIX, a shareholder-weighted index basis. So a form of a closet index tracker, if I can call it that. But if you talk pure index trackers, probably not even 1%. Interestingly enough, despite the very large numbers in terms of growth, even in the US, you still find that the size of the mutual fund industry, the equivalent of our unit trust industry, a lot bigger still in the US than the ETF industry. But the rate of growth has been net positive for ETFs in particular, but also to some extent index tracking products. For 7 years now, you've seen much bigger new money inflows coming into the passively managed space compared to the actively managed space.
Now, again, I was wondering if you'd fall into the growth trap and say we're growing at 30% a year and it's absolutely awesome, or whatever it might be. Because I saw some great stats the other day about online retail versus physical retail, and they've been bragging for years about growing at 30% and 35%, and this is the best year ever. And just this year, they make up 1% of total retail. The online versus physical retail. It's a rapidly growing sector, lots of opportunity. It's wonderful, but it's minuscule. And we're in that same sort of space for ETFs.
Yes, we are. Certainly for ETFs, as I say, index tracking products overall growing quite substantially in the South African market. And I think you're seeing it globally also because of the focus, partly on the focus on cost, but very much also because of a low growth and low return environment. You know, when you're getting 20 or 30% nominal returns on investments per annum, to hide or to absorb cost structures of 2, 3, 4%, is relatively easy. If you're battling to make 5% return, 2% in global markets, even 10% in South Africa, suddenly those sort of cost structures are just not sustainable. And that's why there's such a focus on where and how can we appropriately reduce costs in the investment process.
But also in relatively flat markets, as we've had for the last 18 months, maybe 2 years, the active managers greater number of active managers start outperforming. Historically, you look at 5 and 10-year basis, the direct model works far better, and you outperform the index. You perform along with the index and outperform the most active managers. Now we're seeing more active managers begin to outperform the index because it's not that hard to do with a couple of lucky bets.
With a couple of lucky bets, and also over the shorter term, these things are cyclical. So over the shorter term, it's easier if you've got the perfect storm for active management. But over the longer term, the reason why the numbers remain compelling in favour of passively managed vehicles in the longer term is because that annual cost base erodes the value that you add. So for an active manager, not only does he need to try and beat the benchmark, but he's got to do it on an after cost basis. And let's just remember, an index is just a mathematical calculation. It's got zero costs. It doesn't have any transaction costs. It doesn't have a manager sitting in there. So to replicate the performance of the index exactly is impossible, even for the index tracker fund, but even more so for the actively managed fund.
But the index is also, particularly in South Africa, if you look at the top 40 and you look at maybe the top 5 traded shares on the JSE, having a disproportionate impact on the index versus what an active manager can do, which is all well and good in a bull market.
Or in a market, let's say, for example, Naspers at the moment being the biggest share. If Naspers outperforms the rest of the market and your broad active manager is underweight Naspers, they will all underperform, not because the stock selection on the rest of their portfolio is poor, but just because of that one particular exposure. If they are underweight in a market where Naspers underperforms the rest of the market, suddenly they look like heroes because they all outperform the benchmark index. So I think one also needs to be a little bit more circumspect when we do these sort of comparisons, give credit where credit is due, but also not unfairly criticize the active industry because of structural issues in our indices.
You can't have an active manager with a 15 or 20% weighting to Naspers.
No,
It just is not, there's no mandate that is going to allow that because there's just too much risk associated with it.
Absolutely. And in some, in compulsory money space, so in the retirement annuity space, it's easy to argue that it is actually in breach of mandate. So when you look at Regulation 28, you're not allowed to have that much money into a single company. So I often think that it's quite unfair to specify an index like the All-Share Index, or worse, even the Top 40 Index, as the benchmark against which a pension fund or retirement fund manager is being measured, because the benchmark index is not mandate compliant. So how can you expect the manager to adhere to that benchmark and not be in breach of his mandate?
If it's too risky for asset managers to behave like an index, doesn't that make the index too risky?
Well, no, I don't think it makes the index risky. It's about the choice of which index is appropriate when you measure the active manager against that index.
Investing. Okay, yes. So I've got, let's live in La La Land. I've got 100,000 Rand.
Yeah.
I could give it to 1 or 2 or 3 managers to manage, or I could put it into 1 or 2 or 3 index tracking funds. Now,
exactly, yes.
I could do the low cost option and a relatively flat market versus getting 3 active managers to do me the same job.
Yes. Well,
how do I know what is going to outperform in the next 5 years? Forget the last 5. How do I know what's going to outperform in the next 5? Because I'm no expert on individual shares and in the market. So an active manager is very appealing at that point, but the costs of the ETF are also appealing.
Yes, and I think at the end of the day, it's about what are you trying to achieve with your investments.
I want to make as much money as possible with the least possible risk.
Well, good for you. Can I give you some directions to the closest casino? No, really.
I said least possible risk.
Yeah, but you know what? I think when we look in terms of how one can manage money, it's very much about not just measuring yourself against the benchmark or against your friend or against the next manager. It's about measuring it against your own design, your own purpose, what you want in there. Because if it's only chasing the best return, you will necessarily have to take on undue risk in order to generate that return. You don't get exceptional return without taking risk. So those two concepts are inconsistent. So the best possible return at the lowest possible risk can be done, but not only just the best return.
Yeah, but you asked me what I wanted, and I told you. You're a lousy financial advisor, Nerina, because you tell me what I don't want to hear. But we're seeing money flow into ETFs, which is nice to see. There's $136 million. We've also seen 16 consecutive quarters of capital outflows from South Africa. South Africans voting, these are retail investors, probably on the advice of financial advisors, saying, get money out. It's 14 to the dollar, it's 15 to the dollar, it's 16, it's going to 19 to the... Oh dear, it's back to 14 to the dollar. We've seen quite a big panic out of South Africa with lots of really good reason. Circa 1999 was very, very similar with the emerging markets crisis. Yeah. give me a read on what the money coming into ETFs is telling you.
So what we're looking at here is really, and some people would refer to the international investor being the smart money, whereas the local retail investor could be viewed by some as the not so smart investor. So in other words, reacting after the fact the rand has depreciated, let me now take my money out of the country. Whereas the international investor is not just looking at South Africa, he's looking at emerging markets, and he's looking at emerging markets from the point of view that he's got very low cost of capital in his developed market. Interest rates are on the deck. They've seen significant decreases in emerging market currencies as a whole, and they say, what are the chances that emerging market currencies as a group are going to depreciate by another 30 or even another 20 or 10% over the next year? A lot less is that chance. And they say, you know what, in the environment where I'm only going to get, if I'm lucky, 1 or 2% return in my home market, let me rather deploy some of that money into emerging markets, because there I can get 9%, 10%, and if the currency still works in my favor, that adds to my exposure. So what we've seen in terms of the money coming into South Africa is part of a major move back into emerging markets. Now, one of the very interesting things when you look at South Africa and the way, the sort of the size and its role in the emerging market universe, as South Africans, we tend to look at our JSE and things like our all share and top 40 index on a whole. So we look at our big deal listed companies like BHP Billiton, SAB Miller, British American Tobacco and the likes, and we look at those and we say they are part and parcel of our market. The international investor looks at South Africa and they say, no, those are London listed companies. I will buy them in London, I will access them there. When I come to South Africa, I come to it on the basis typically of the MSCI South Africa index, which only includes companies that have their primary listing on the JSE, which is a very different universe than our top 40 index.
You're not getting Anglos, you're not getting Old Mutual, you're not getting all of those.
None of those, because the international investor will be buying those in London.
So we're getting some quite nice South African buying going on.
Exactly, and this is really an investment into South Africa Incorporated, if I can call it that. So you're going to see the movement in shares that are somewhat outside these mega caps that dominate our overall indices, and lots of interesting performance and opportunities then coming through on some of our smaller top 40 shares and certainly our mid-cap space as well. And that's something I think that we need to watch very carefully.
Unfortunately, we have to leave it there. Nerina Visser, nice to see you again. Nerina Visser is an ETF strategist. She's an advisor at ETFSA, and she knows a huge amount about markets, exchange-traded funds, and of course, those that shall not be named, the managed funds as well. There'll be more talk about money and everything to do with MoneyMakers next time on the show. Thank you so much for watching. Bye-bye.